What's up, guys? David Reza from BTC Group Laredo, and today's Tax Talk Thursday is going to be about the differences and the pros and cons between an LLC, a C Corp, and an S Corp. Let's jump right in. An LLC is always recommended for new startups because of its simplicity and its flexibility, but most importantly because of the legal protection it provides. So because of the nature of our industry, God forbid we have an incident, we don't want our personal assets to be up for grabs. That's why we always recommend to our clients that we have at least an LLC in place in order to protect ourselves. Another pro are deductions. So we're allowed to deduct expenses that are considered ordinary and necessary for our industry. For example, fuel costs, repairs, per diem, as spoken about in a previous video, check it out, and depreciation. So the IRS allows us to take depreciation expense on the full value of our semi-truck. But sometimes that's not the most beneficial if we have a low income year. It might be more beneficial to depreciate that asset throughout several years. One con for the LLC is self-employment tax. So self-employment tax is how self-employed individuals pay Social Security and Medicare, which comes out to about 15.3%. So apart from having to pay income tax, you also have to pay self-employment tax. So with good tax planning, we can mitigate this. But after a certain income level, we do recommend to convert to a C Corp or to an S Corp. So C Corp. One of the pros to a C Corp is that there's no tax brackets. Right now, the corporate tax rate is 21% flat. So whatever business income you incur, all you're going to pay in taxes is 21%. On the contrary, with an LLC, the level of tax that you're going to pay is dependent on the level of income that you have. Another pro is that you're open to more deductions. You're able to pay yourself, and when you're able to pay yourself, you're able to pay yourself fringe benefits like retirement, healthcare, all of that's tax deductible. One of the cons for a C Corp is double taxation. So if you want to take money out of your business other than in the form of salary, you can do that with a dividend. But the problem with dividends is that they're not tax deductible on the corporate level. So let's say you made $100,000 and you want to pay yourself $20,000 in dividends. You won't be able to deduct those $20,000 from your corporate income. Therefore, you'll pay tax on the full $100,000. And you'll also have to report those $20,000 in dividends on your personal return. So an S Corp. One of the benefits of an S Corp is that, like an LLC, it's a flow-through entity, meaning that the company doesn't pay the tax, but the individuals do. The only difference here is that you don't have to pay self-employment tax on this income. One of the conditions of having an S Corp is that you have to pay yourself a quote-unquote reasonable salary. And you do have to pay self-employment tax on this income only, not on the full business income like you do with an LLC. Another benefit is tax-free distributions. Distributions is the equivalent of dividends with a C Corp. And like in a C Corp, you cannot deduct distributions from your S Corp income. But you do not have to report these distributions on your personal income tax, which avoids double taxation, as long as you don't exceed your shareholder basis. Now, one of the cons for an S Corp is that you now have an administrative burden compared to with an LLC. Now you have to make monthly tax payments for your payroll. Now you have to make quarterly payroll reports and yearly payroll reports. So if you want to find out which tax structure is the best fit for your company, contact us for a free tax consultation and ask about our monthly tax and accounting services. Thank you guys. Have a great day and God bless.